Millennial home buyers, here is my best piece of advice for buying a home. The most important advice I can give about buying a home is education. Educating yourself on the home buying process is absolutely the most important first step. I've been a residential home lender for over 26 years. This channel is all about home loan education. I would encourage you to watch other videos and ask a lot of questions. It's okay. If you're considering getting a home loan, it's important to use a lender that is willing to come alongside you and help educate you on the home loan process. Everyone's life is unique, and in turn, that means their lending situation is unique. Working with a lender that has the resources and tools that allow you to learn each step and to understand how they apply to your situation is absolutely vital. If you are currently renting, it's a good idea to compare the numbers of renting versus owning. If you're in a good financial position with your credit, have a healthy debt-to-income ratio and financial reserves such as savings, you may be able to purchase a home for that same payment right now. Then you are having your monthly payments go towards something that is actually gaining equity and help you build wealth over time. So let's begin with the few things you may want to know. What is a mortgage? What is a home loan? Why are we even doing this? A mortgage is an agreement between you and a lender that allows you to borrow money to purchase or refinance a home. The loan is paid over time in a series of regular payments, most often over a span of 30 years, but you certainly could repay it in less than 30 years. What type of loans are out there? There are actually three primary types of home loans out there that are most often used. One is a conventional home loan, the other FHA, and VA. What types of things are needed to qualify for a home loan? Well, lenders are going to be looking at really four different categories. The first one's going to be employment stability, or really income stability. If you have a source of income that meets the lending guidelines and you're not employed, that could absolutely work. So a lot of people think, oh my gosh, I don't have a job. Maybe I'm retired. Maybe I get Social Security. That doesn't mean that you're not able to qualify for a home loan. But if you are employed and that's the income that's being used for the home loan qualification, then generally lenders want to see that you have a 2-year employment history. Now, if you've recently just graduated from college and graduated with a degree in what you are now working in that industry, then your schooling can suffice for employment history. So employment stability, kind of think 2 years if again you're using a employment to qualify for the home loan. Second thing is your credit history. Now this one can be challenging, especially for younger people that are maybe just getting started to build out their credit profile. Credit score is huge when it comes to home loans. It's the driver of interest rate, cost of mortgage insurance, etc. So from a credit history standpoint, the longer you've had credit, the stronger that credit profile will be, and in turn could positively impact your credit score. But let's say you're just starting out. Some of the most important things to know about actual credit history is that if you have a revolving credit account, generally that's a credit card, you want to keep that balance at 20% or lower of the limit. That's already going to help maximize your credit score. From a lending standpoint, the credit scores are going to vary based on the home loan that you're qualifying for. So think anywhere from kind of a 580 up to an 800. That's a wide range. Some programs will go down that far to the lower end of that. Some programs won't. Sometimes if you're going under a certain credit score threshold, it will increase your cost of your mortgage insurance. So it really depends on the type of loan that you're applying for, but just realize credit history is a factor and it's going to go into your home loan pre-qualification. Debt to income ratio, what the heck does that mean? Essentially, here's what it means. The lender is going to determine what your usable income is, and they're going to ensure that you have the ability to repay that home loan, and they're going to back into this ratio based on your debt, including the new house payment and any HOAs on that new house, and they're going to divide that into the usable income on the home loan. That's all that a debt to income ratio means. But as you talk with a lender, you're going to hear that term more and more. And then lastly, assets or financial reserves. So we have to document where your money is coming from. And that's required by the lending guidelines across the nation. And so by that I mean that if your home loan requires a down payment, then where that down payment's coming from. In addition to down payment, You're going to have closing costs, so we have to understand where those are coming from. And when we think about down payment and closing costs, I like to separate them because essentially they are two different things. Remember, from a down payment standpoint, it's actually your money that you're putting down on the purchase of a home. So that's already going to give you equity. That's your money. It's there. It's now held in equity. Whereas closing costs are separate. Closing costs are going to be costs to acquire the property and the home loan. So some of the closing costs that are associated when purchasing a home loan are you're potentially going to have an appraisal fee, you're going to have lender fees, you're going to have your property tax escrow account requirement, you're going to have homeowners insurance for the first year, you're going to have your escrow requirement for homeowners insurance. You may have a home inspection. Depending on where you are in the country, you could have transfer taxes. So there are going to be closing costs associated with that home loan. A lot of people think closing costs, oh, that's just the lender cost. No, when we talk about closing costs, we want you to know that it's like an all-in number that you can expect based on the price point, the area, the property taxes, the homeowner's insurance, and all that fun stuff that all gets added together. That will summarize closing cost. Some other things to keep in mind are mortgage insurance, private mortgage insurance premiums. They're going to vary based on the home loan type that you're obtaining. So here's kind of like a quick summary. On a conventional home loan, mortgage insurance is called PMI, so private mortgage insurance. It is required if you're putting less than 20% down payment. Now, a lot of people think they have to put 20% down to buy a house. No, you don't. And that's where mortgage insurance comes into play. I actually think it gets a bad rap. I think a lot of people are like, poo, mortgage insurance, I don't want to pay mortgage insurance. Here's the deal. It would take you a long time to save for 20% down, as opposed to, if you don't already have that money, as opposed to being able to maybe put 3 or 5% down or 10% down, buy the house now, and then build equity over time. That is another way that you can build wealth over time and not have to wait until you're doing 20% down. But back to mortgage insurance. Okay, so on a conventional loan, PMI, the cost of it is driven by the down payment and the credit score and the occupancy of the home. So for example, if you're purchasing the house and you're doing 3% down, the cost of your mortgage insurance will be higher. So 3% down, primary residence, that means it's going to be the home that you're going to live in and occupy as your primary residence. And your credit score, that's going to drive the factor that drives the cost of mortgage insurance. Now, if we move away from conventional mortgage insurance or PMI and we start to focus on FHA, FHA mortgage insurance works completely different. Going back to conventional real quick, at some point in the life of the loan, the mortgage insurance will drop off that home loan payment. When we go over to the FHA side, mortgage insurance is a flat fee, so it's not driven by your credit score. FHA only allows financing for primary residences, so occupancy's off the table in that equation. And down payment is not driving the cost of mortgage insurance on an FHA loan. So it's a completely different animal. You might ask, well, why would somebody use FHA then? Well, FHA's guidelines are completely different than conventional. So sometimes somebody can only qualify for an FHA loan because they're a little more user-friendly on certain criteria that goes into that home loan approval process. So the way mortgage insurance works is a whole conversation in itself. If you have other questions, be sure that you're pressing and you're talking with an experienced lender that can really evaluate and tell you based on your situation, which program's the best, and then how the mortgage insurance works on that particular home loan. Now, as you go through this conversation, you're going to see this whole commentary about APR. That stands for annual percentage rate. So what's the interest rate versus an APR? Really great question. And it's so great that I've actually done a different video on it that'll dig deep into answering that question for you. Be sure to check it out.